started getting sued for billions and billions of dollars by all these different publishers. OLX became huge. It's 100 million users a month, tens of millions of people making a living off the site every month. We grew it to, I think, 11,000 employees at the beginning. I started investing already into 98. And so by 2013, when I sold and left OLX, I'd already made 173 investments, like dozens of exits. There are 2 TV shows following me around in my life as a founder, and it was like #1 TV show in France. You know, people watching it, and we even had the opportunity to buy Shazam for like $1 million. Paid back the employees a back salary, and then it became a rocket ship. We went from $1 million in revenues in '02, 5 in '03, 50 in '04, 200 in '05, and this time we grabbed victory from the jaws of defeat.
Fabrice Grinda is a true pioneer in marketplaces and venture investing. He joined Princeton when he was 17, worked 3 jobs, and still graduated top of his class. By his mid-20s, he'd set the record on the largest seed round for any French startup at $18 million, only to experience a brutal lesson on exits. But he bounced back and built Zingy, which he grew to over $200 million in revenue and sold for $80 million in cash. Not one to rest on his successes, Fabrice then went on to found OLX, a global giant in classified ads, with over 350 million users. Now, as a co-founder at FJ Labs, he's one of the world's most active angel investors and has a portfolio of over 300 startup investments. Let's dive into his journey, the wins, the losses, and the frameworks that he uses to identify the next billion-dollar opportunities. But just before we do, let me introduce this week's sponsor of the OpenVC Podcast, Intercom.com. Intercom help founders by making your customer service 24/7. Through their use of innovative AI, you can answer 50% of your customer needs instantly. Intercom is offering 1 year free if you use the code OpenVC, all in caps, at the checkout using the link in the description below. And let's get back to the episode. So you had that ambition to be a founder from a young age. You went out, you built your toolkit, you got your credibility working at McKinsey. Can you tell us a little bit more about Auckland, the first tech startup that you had?
I finished McKinsey, I was 23, but I didn't know what to build. And so I'm like, you know what, maybe to start, I'll just take an idea from the US, bring it to the rest of the world. Also, a lot of the ideas, in a way, required a lot of, especially back in the day, a lot of skill sets and or capital I didn't have, right? Like if you want to build Amazon, you need billions in like inventory and warehouses and supply chain management skills. If you want to build E-Trade, you need like banking licenses, etc.
Well, cloud didn't exist, so you had to build the physical infrastructure, which was already.
Oh yeah, no, I built my own data centers. I built my own data centers. We had to get Oracle database licenses, and Microsoft web servers. I mean, just turning the lights on is like $1 million. The times have changed. So kind of randomly, I saw the site of eBay in June of '98, and it was another one of these aha moments of like love at first click. Like I studied economics and mathematics at Princeton, including market design, and the idea of creating markets which have liquidity, which unlock a tremendous amount of value, resonated with me. And I realized, okay, if you go to these offline flea markets, you're unlikely to find what you want. If you want to sell, you're unlikely to find a buyer for what you have. But if you put all that online, you create this virtuous circle with ever more buyers practice, ever more sellers, and so on and so forth. And I thought, this is something. Yes, marketplaces have a unique problem of chicken and egg, but it's a problem that I'm uniquely well positioned to solve, given that that's exactly what I've studied. Market design and measuring elasticity of supply and demand to figure out what an effective take rate is, thinking through how you match supply and demand, etc. And so I decided to go and build an eBay for France, and Europe ultimately, which was called Auckland.
The journey with Auckland was off to a running start. I'm not sure how long it was before you had the largest fundraise of any French startup ever, with $18 million, and actually funded by the family office of Bernard Arnault, I believe. Can you tell us a bit about the journey of building that company before we get into, just as interesting, the ending of that journey?
Well, the beginning of the journey was interesting because in the US there was a full-blown tech bubble going on, and it actually had not yet reached France. And so even though I built the company, I built the code, we launched, it actually hadn't reached the level of hype. And every VC I talked to, and I was like, I want to raise like 10 million, do a proper fundraising. They were like, nah, it's France, $500,000 or $1 million. And I just didn't want to do that. Kind of engineered the press hype around the company and around me people did not take PR very seriously. And so in France, the CEOs of the companies were like barely talking to the press. And I
Okay.
basically reach out to the journalists and say, hey, I'd like to tell you about like what I'm doing. None of them would take me seriously because I was 23 or 24. But I'm like, you know what? I'll come to your office and just chat. And of course, I had a compelling story to tell. So each 1 hour conversation led to an article. And then I became kind of the go-to person for them to ask questions about tech. So they would send me a
Mhm.
question. I would send them the article back, and literally they would like copy and paste the article, publish it. I mean, they're lazy, and
Yeah.
so very rapidly became the go-to PR person to ask tech questions. First in the written press, then radio, and finally on TV, like the 8 o'clock news, etc. At the same time, people started realizing this internet thing was bubbling, and it became a bit frothy. And all of a sudden, like it switched. It went from no one caring to everyone wanted to invest in the category. And Arnaud, amongst others, started reaching out and saying, "Hey, we want to back you." And actually, I remember he actually bid on a foosball table, or his secretary did, and the transaction went well, and realized there was something there. And so talked to him and the other people. He offered the highest valuation and the most capital, which was why I chose to raise capital from him. And we were off to the races. I used the capital. We launched a super successful TV ad campaign, which was the way to reach the masses then. Traffic exploded. We grew to like 100 plus employees in 5 countries, 10 million a month in GMV. Things looked actually like we'd made the right choice and everything was going
Yeah.
well.
Did buyers started appearing? I believe there was some talks with eBay at some point.
So eBay, I met Meg and Pierre early before I raised the capital
Okay.
from Arnaud and Europe at Web, and they actually offered me like 25 million or 20, maybe 20 million. And at that point, I owned 75% of the company. And but the delusions of grandeur and arrogance of a completely penniless 24-year-old at that point. I'm like, whatever. It's money. It doesn't mean like I'm not. I'm doing this to build something meaningful. 15 million is nothing. Like, and I really meant it. Like, and it's funny because
Just
I like
dismissed
literally
it, literally, just managed to dismiss it out of hand like that.
I didn't even consider it. Since then, I've learned how hard it is to make money and how easy it is to lose it. But like, yeah, 15. I was gonna make 15 million at 24, and I didn't even for 1 minute consider it. I was like, nah, it's nothing. I'll make it later. What doesn't matter.
It's similar
And
to your heroes, though, like Zuckerberg turning down 1 billion when he was building
yeah.
Facebook.
And for a long time, it actually looked like it made the right call, right? Like the company grew very rapidly, and then eBay came back maybe 9 months later and offered like 300 million in cash. So clearly,
Whoa.
the turning down 20 to take 300, despite the dilution that happened along the way, made sense.
Okay. Who's stopping you taking 300 million 9 months after the fund rate? But yeah.
Well, as a first-time founder, you make a lot of mistakes. One mistake is, you shouldn't necessarily raise the most money at the highest valuation. Picking a VC is like getting married.
Mhm.
They need to be with you in good times and bad times. You need to see eye to eye and like where this is going and what the vision of the company is. And turns out that when the person backing you is one of the wealthiest people in the world, making more money is not necessarily their core objective. And I came to Arnaud and he's like, no, I'm not a mere financial investor. Making 10x in 6 months, that's not for me. I'm an industrialist. I want to be perceived as the old school guy who got the internet. And he's like, no, I don't want to sell. Normally, I would not want to sell now. I don't want to sell ever. Like, I'm not in it for the money. And I was
Whoa.
like, that would have been nice to mention when you invested in my company. And usually it's not a big deal because today you have these standardized documents and there's a drag along. If I want to sell, I can force other people to sell, etc. But again, when I signed these documents, I was 23, had no idea what I was doing. I trusted my lawyer to negotiate the right things. Of course, they didn't take me seriously. Even though they were a very well-known law firm, I don't think they took me particularly seriously because I was so young. And yeah, they did a really bad job, didn't have any of the relevant rights to force a sale of transactions. Sadly, we grabbed defeat from the jaws of victory, and what would have been an extraordinary exit led to essentially nothing. Sold to a company that he wanted to sell to, whose stock promptly fell 99.98% from like 10 billion in market cap to 30 million. I mean, it was a total disaster. It's basically left the company with barely more than I started with. So, but interesting life lesson at someone else's expense.
I've read that the press weren't too kind to you after that success became a bit of a failure in their eyes. How did you handle that? What kind of resilience? Did you have any tools, any techniques to help you get through that that would be helpful for founders to hear about today to
So first of
manage
all,
that pressure?
I mean, look, I never took that seriously, like, oh, you're worth $1 billion or whatever, because first of all, I realize it's monopoly money, right? Like, virtual value of your shares does not allow you to buy an apartment or a car, let alone buy coffee. So it's virtual, and I realize we're in a bubble, and then at some point the bubble would burst. So from that perspective, my feet were reasonably well grounded and didn't let that success get in my head. The bigger concern for me was I had been at the right time, at the right place, with the right skills, and I'd failed to capture in that opportunity. And I worried that this was a once in a lifetime opportunity where young people with the right type of skills and background were given an opportunity to, in a way, like shortcut the different path that you could get, you had to go through in life or hoops to become successful. And I'd blown the opportunity. Even though I'd executed in many ways perfectly from a product perspective, getting liquidity, building a website, etc., from a financial perspective. But at the end of the day, I didn't do this for the money. So I'm like, you know what? Maybe the internet is going to be this niche little toy thing that only nerds like me are going to play with, and there's no money in it. But I like building something out of nothing. This is my form of creative expression. And so there's no money in it, but I'd rather stay in the internet. This is what I love to do, and I'll go and build it again. So yeah, I was a bit disappointed and disappointing, but because I never let like the hype get in my head, the disappointment was more about like the fact that I'd missed the opportunity, and now I was going to, I was just going to be doing this little niche thing for the rest of my life. It wasn't going to be meaningful or big. So that was more the disappointment. But at the end of the day, I was like, you know what? I like what I'm doing. That's all that matters.
Do you have a favorite memory of that time of building Auckland?
Lots of little victories, right? Like turning the lights on, having the first transaction, having we created a TV ad that was so shocking that we won a silver line in Cannes for like creativity, to when I made the cover of the French Fortune, basically, or being the 8 o'clock. All these were amazing. There are 2 TV shows where they're basically following me around in my life as a founder, and like and it was like #1 TV show in France. I don't know, like 20 million or 30 million people watching it, and like an entire episode was just like following me do business. It's like pretty insane, the level of like fame and recognition, etc., for a otherwise shy, introverted 25-year-old.
Was personal brand a part of this, or were you always trying to push the platform?
No, it's both. I thought it would be helpful, and for both getting traffic and getting revenues. I think it was more meaningful then than it is today. Like today, I don't care for visibility. Like I don't have a publicist. I don't want a big following. I have exactly the right level of fame. I think it would get in the way if I was more well known in terms of my quality of life. And so that I don't pursue it in any way, shape, or form. It was a means to an end. Ultimately, I don't think it was actually all that as helpful as I thought it might have otherwise been. Perhaps doing that in the early days probably helped me get fundraising or capital in a way that I wouldn't have had otherwise. But it didn't bring that many users, because the users are not reading Forbes and Fortune and the Washington Journal. The 2 that were helpful were like the big TV ones where they were following me around, but even then, it's pretty short-lived. One big TV ad at like in prime time on one of the major channels would have probably had just as much impact. But I did like the attention, and I realized that speaking came very naturally to me. And I'm not sure I created a persona. I was just myself. I was like be your authentic self, and I think it resonates when you're your true authentic self to other people. Even though I am more direct and transparent than most people, and sometimes it makes people uncomfortable. But people realize it's genuine, and that's all that matters.
And then you reinvented yourself to create Zingy. For the audience that don't know, what was the business, and why did you choose that particular sector?
Zingy was a mobile media company, but to be more specific, we basically sold ringtones in the U.S. market. In the old school days of like the Motorola flip phones and the Nokia phones, people loved to personalize their devices with wallpapers or play little games or ringtones, which are the bigger category. And I chose the category despite not thinking it was particularly large value add for humanity, and I never even listened to music in my life. My prime directive was I wanted to be a tech founder. And in 2001, when the bubble had burst and no capital was available, I needed a company that I could build with very little capital and make profitable quickly. And as I looked at the types of companies I could build, almost all of them required reasonably large amounts of capital that was essentially not available. And this one, the few companies that were around doing it in Europe and in Asia were all profitable. And I'm like, okay, this is something that doesn't seem all that hard to execute that I can go build. The US is like years behind. There's no like text messaging within a carrier, let alone between carriers. There's no mobile payment solutions. We're like US dark ages when it comes to mobile. So let's try to see if I can bring the mobile revolution to the US market. And so that was the genesis of the idea, because I just wanted to be a founder and the idea didn't matter. Now, model, the way it's worked in the rest of the world was actually B2C. You sell directly to the consumer, but the consumer can pay through their cell phone, and it works on every phone. In the US, you had all these different networks like GSM, TDMA, CDMA, IDEN, etc. They were all incompatible. None of the carriers had delivery mechanisms into their platforms that were open, or frankly didn't even have any of them. And there's no billing mechanism. So the only way to launch, frankly, as a proof of concept was directly to the consumer, where we literally hacked into the delivery mechanisms of the carriers to deliver. They didn't even know you could do that. We hacked into it and showed we could deliver into the networks, and not all of them, a subset of them. And so in order to order the ringtones at first, you had to pick your carrier, pick your phone model only from one of the phones that were available, so you needed to know where that was. And you had to enter a credit card number on the web. So you can imagine the volumes were extraordinarily low. And the music companies didn't take this seriously. None of them wanted to give me a license. And there was no, in other countries like France, there's a centralized music repository where you can just go get a license, and poof, you get a license to all songs, and you pay whatever, 10 cents a download or 10% of the revenues. In the US, there was no standard contract, no standard licensing, and even no database of who owned what. So we had to go on this detective hunt of figuring out which artists worked with which writers, songwriters, because we needed the mechanical rights, which were owned by the songwriters, which were represented by which law firm to try to figure out, and by which music publishing company to try to get the rights. Even when we did figure it out, after massive detective work, the music companies often didn't want to give us the licenses. And so even though I was like offering to pay them, they just didn't give us the time of day. So we did a number of different things. At first, I documented who owned what. We launched violating every we didn't even have licenses. We violated every copyright law in the world. But we would actually be sending checks to the different music publishers as though we had a contract. And they pretty much all of them deposited it. And so eventually they caught on to it, and the penalty was like $250,000 per download infringement. Insane penalty. So I was started getting sued for billions and billions of dollars by all these different publishers. And the lawyer, so I'd get the cease and desist letter or whatever, and the multi-billion dollar. And I would call the lawyer like, I'm so excited that you've reached out to me. I've been trying to talk to you for so long. This is amazing. And to be like, who is this crazy guy? I'm suing him for like $1 billion, and he's like so happy to talk to me. And I'm like, look, I actually want to do the right thing. I've wanted to do deals. I've wanted to pay you. And by the way, I've paid you. You've deposited the checks. You're all the checks. So I would argue I have an implicit contract. And if you want to sue me out of existence, you can, but it'll cost you more, and then just settle with me. And so I ended up settling with all the music companies, obviously for what I owed them, or maybe 2x what I owed them, not like the crazy penalties. Yeah. And I ended up being the only licensed player in the US. No one else was trying to, because they went after me, and I was just friendly. And also, I put every last penny I had in the company. I borrowed $100K on my credit card. We had no revenue, so I missed payroll, I think, 27 times. Every 2 weeks we make payroll. If I miss payroll, I'd be like, I don't understand, like something's wrong with the bank. They suck. They keep not wiring. Of course, there's no money in the bank account to wire. But then I'd meet someone and convince them to put $5K or $10K in the company to like make payroll. And so that happened over and over again for the first like 2 years, basically. But little by little, laid the groundwork for what would lead to the success, meaning we got the licenses. Then, in order to, I kept knocking on the doors of all the phone carriers, but they're big, ginormous companies. They don't work with startups. They're afraid we're not going to be around in the future. And so I went to all the shows. They didn't even want to give me a meeting. Like, I would shake their hands, make sure they heard my name. And so I kind of engineered the first deal. So MSN, which is like the Microsoft portal, they were desperate for revenues. I paid them $100K to become their official ringtone provider with the tab ringtones on MSN portal. And then we got a press release, and that got a little bit of attention. Then I got Motorola to inbound me, and they're like, hey, we're running the ringtone portal by web for Nextel. Do you mind providing them to us? So that was a first contract. And then Sprint came calling and says, hey, we're thinking of launching ringtones. Do you have any license? And I gave them like 25 of them. And that took on. And once that took on and worked, all the other carriers were like, wait, we need this. And it became a frenzy where we signed every operator in like a 3-month period. And there was a question of launching. We finally got that. So we launched on Sprint in March or April of 2003. We didn't even know how well we were doing because it was on their platform. We finally got the check August 15, 2003, which is when we became profitable. And so we were saved. I mean, I lived on the couch of the office for 2 years, like living on $2 a day. I could only eat ramen noodles. So I paid back my credit card debt, paid back the employees' back salary, and then it became a rocket ship. We went from $1 million in revenues in 2002, 5 in 2003, 50 in 2004, 200 in 2005. And yeah, this time we grabbed victory from the jaws of defeat.
How much were people willing to pay for ringtones back then?
More than you would think. I started at 99 cents, then I increased to 149, then I increased to 149, then I increased to 249, then I finished at 299, and we never saw declines in volumes. 299 in ringtone, and if you were especially a teen and you wanted really the latest hook of the latest song to provide social currency, and so people would change almost every week or every other week. It became a much bigger business than people expected. The top songs of the day were extraordinarily popular, and we were generating more revenue to the songwriters and the artists than traditional music sales, which at the time were being all pirated by like Napster and whatever all the different LimeWire and things like that.
1 million to 200 million in 4 years in revenue.
Yep,
And then you end up selling the Japanese company, if I'm right on that.
that's correct.
Could you tell us a little bit about what you learned from selling?
So the first thing I learned in selling is use a banker. We were approached by the Japanese buyer in Q1 '04, and they offered 40 million, which of course at that time I owned the majority of the company. It was like a life-changing amount. I was like, okay, I've learned my lesson from the prior time. This is meaningful enough that I should probably take it. I hired Broadview, which now is called Jefferies, to run a process, and it doubled the price. So we ended up closing with the same seller, but they ultimately bid 80 million. So I sold for 80 instead of 40. And by running process, making it competitive, we increased the price dramatically. Number two, while you're negotiating the stock purchase agreement with a buyer, having someone be the backup is very useful because you're going to have to work for a certain period of time with the buyer. And so you can't be the one creating a bad blood negative relationship with. What I would actually be the one driving the negotiations on the back end, but like whatever I said, I wanted something different. I would say, look, I love you guys. I want to work with you, but my bankers are telling me this is on market, and I don't want to look foolish. So if you change that, I'll make sure it gets through. And so I appear as the good cop and the person solving the problem. So bankers, amazing when it comes to deals above a certain price, and definitely 40, 50 million past that threshold. Number two, if you do an earnout, make it a revenue earnout more than EBITDA earnout because the buyer controls in a way your cost structure, and so they can change your EBITDA, and that will lead inevitably to a lawsuit. Much better actually if you have an earnout to be just time based. You need to be there and making sure that like easy things happen, like the hand of control, Now in my case, I actually stayed longer than you might think. I stayed for 18 months. Because actually in the early days it was fun. Like it was part of a hypergrowth company going from 50 to 200 million. We were changing offices every 6 months. We were expanding the product lines, adding gaming, adding full-blown music ringtones, negotiating deals with labels. We even had the opportunity to buy Shazam for like $1 million. Now ultimately the reason I left is actually because all the ambitions I had, which included like buying Shazam, etc., were thwarted because the Japanese just said, no, I need the profits. And so they would take all my profits and ship it to Japan and didn't let me continue building the empire. And so we're like, at the end of the day, didn't particularly love the business, definitely didn't like them. The cultural differences were large. But I don't regret selling to them because they paid the most and in cash. and it was reasonably easy to keep doing my own thing on a go-forward basis. So I'm actually no regrets from that perspective. I mean, I would have wished they'd let me continue to try to build it into something bigger, but the fact that they didn't led me to the next adventure. So no regrets.
Okay. So you've been living on $2 a day with ramen noodles 4 years ago. Suddenly you get this massive paycheck, all liquid, full cash. What's top of the list? What do you splash out on straight away?
Nothing, honestly. I stayed in the same studio apartment. I bought a TV, an Xbox, and 2 tennis rackets, which probably cost me $1,500 max total. didn't do it for the money to begin with, and I saw money as a means to an end, like to have the freedom to build my next company without needing seed capital or pre-seed capital, to not have to worry about like, if I don't food again, like the way I did for 2 years, or rent or whatever. But no, I didn't change anything in my life. Partly because we're so busy. Like the more meaningful day was the day we became profitable, because the day we became profitable. And I, like, that day, full on popped champagne. Like, we were saved. Like, we were the masters of our own destiny. We were not going to die. And that was like probably to this day the most meaningful day of my like business career, because like until then there was always a moment where it looked like we could die. And from that day on, it was like, okay, now we're saved, we're good. Settling was just like another step, but at the moment we closed in like May or June of 2004, was like the hypergrowth mode. Part of the reason I sold for, in a way, that little relative to what ended up being our 2004, 2005 revenues is in Q1 04, we closed 4 million revenues, 1 million EBITDA. And the Japanese asked me for my projections. And of course, you never know these things. So I'm like, yeah, I don't know. We'll make 20 million revenues this year, 4 million profits, maybe 50 million next year, whatever, 7 million in profits. Had I known we're going to do 50 and 200, I would have waited a bit longer. Again, better too early than too late, and better for cash and stock. But as a result, when I sold, we were like growing like this. We were literally, we're moving office. I'd taken office, we were 7, then we became 25 by the time I moved office. I've taken office for 75 people, like, yeah, we'll never move out of that. Like 6 months later, like, oh shit, we need a bigger office. So we kept moving offices, hiring people, launching product lines, growing like crazy. I was working so hard that, yeah, it didn't change anything in my life, because my life was still building my business. But actually, because when people are like, okay, does working really hard pay dividends? And the answer is absolutely yes. But if there are two people competing, and one is doing it for fun and the other one is doing it because they feel they have to do it, the person doing it for fun will win every day of the week, because it's not work, it's fun. And so, college, frankly, in high school, my first startup, yeah, I was working 100-hour weeks. Traditionally defined, it's work, but I didn't think it was work. I thought it was play. And so, because I thought it was fun, I was just doing my hobby and being compensated for it. So other people that are doing it for work, they're getting burned out. And if you do something you love doing, you don't get burned out. It's just what you do.
I think that's more true for founders because they encounter so many hurdles, so many no's, so many failures. Unless you truly love it or you find some passion, some joy that makes you a little bit delirious. And the
Yeah,
1% that manages to get to the finish line, it's extremely hard to get there without that. So there's definitely a lot of
absolutely.
truth to what you're saying. So third company now, OLX, which also went on to become an absolute juggernaut. But for those of us that aren't fully aware of that company, can you give us a bit of a market landscape and why there was actually an opportunity for OLX? Because I know there's a really interesting story when it comes to Craigslist
Yeah, so
and what you tried to do
2005,
there.
yeah. So obviously my true love originally was marketplaces. And so I kept an eye on what was going on in that world. And of course, eBay had gone from strength to strength. 2004, 2005, Craigslist came into its own in the US and became part of the fabric of society, and it was a place to find roommates and apartments or jobs and items. But even back then, it looked like it was 10 years out of date from a user interface perspective. And just as importantly, I didn't think they did a very good job in moderation. It was full of scam and spam and phishing. They basically didn't have a moderation team. The latest listings would be the latest posted, and then they would use the community to like mark the bad ones to eliminate them. So all the latest listings were always the worst ones. It made no sense. So I went to see Craig and Jim, and I'm like, hey, I love what you guys are doing. You're providing an amazing public service to humanity and the community, but we can do it better. Like, let's moderate, let's improve the UX UI. You may not want to, you may not have the money for it, but how about that? I'll do it for free. Like, I just sold my company. I don't need money. I'm happy. I don't need anything. I don't need equity. I don't need cash. I will do this as a service to the community and to humanity. And I know they didn't give me time of day. They didn't care. They literally didn't care. I think in one of the meetings they were like so high on like weed that they were like fading in and out of consciousness. And every time I met them since, they never remember meeting me before. It was like pretty weird
Wow.
interactions. And I'm like, you know what? If I'm gonna compete with someone, might as well compete with the person who doesn't care.
Yeah.
Now, the issue is in the US, they already had liquidity. In marketplaces, liquidity and network effects are so powerful that breaking them is very hard. But the opportunity was, while it was big in the US and there were few established incumbents in Europe, and most of the rest of the world, that no one was doing this. And Classifieds is actually an amazing product for an emerging market, because in countries where there's no trust, where there's no online payment, where there's no shipping systems that work, actually meeting at your street corner and exchange a good for cash is actually a very viable option. And so I decided, you know what, I'm going to build a better version of Craigslist for the rest of the world. We're going to go mobile first. We're going to focus on women, because women are the primary decision makers in all household purchases, right? They decide the car you drive, the babysitter you hire, the house you live in, and pretty much everything else. And yet Craigslist is the least female-friendly, safe site in the world. And we're going to start with consumer used goods, because those have people buy them on a regular basis, so we start getting a lot of organic traffic, and from there we're going to go to cars, and then real estate, and jobs. And that was the vision. I'll pause here for now.
I mean, you didn't go slowly. I've read a little bit about your first go-to-market strategy, which seems bonkers, but there's a lot of good thinking in there. Could you tell our audience a little bit of how you managed to launch in 100 countries to test the different markets?
Yeah, a couple of months. I mean, basically, when you build a marketplace, you want to sort of supply, so you get sellers on the platform, and you just go to all the sellers, like car dealers, real estate brokers, are like, look, I'm building a website, it's free to list, I don't have an audience right now, but perhaps you'll get buyers, so, do you want to list? And everyone kind of says yes, so you get supply. We built a little sales team in Buenos Aires, in Argentina, that was multilingual, that spoke all the different languages of the countries we attacked. And we created the site, 100 countries, I don't remember, 30 or 40 languages, launched, and then we spent $50K per country, so $5 million total, to test where we could get the flywheel going of ever more sellers buying, bringing more buyers, and so on and so forth. In these things, there's a level of randomness. There are a few countries where it really, really resonated, and it really, really, really picked up in Portugal and Pakistan, and it picked up lesser scale, but still very well bigger scale overall, but lesser scale as a market share of the country in Brazil and India. And so from the 100 countries,
Sorry to interrupt, but what does that look like? What does that outlier look like? Is it 100 times return on your capital on the marketing? How obvious was it to spot it, or was it marginal differences?
No, it's pretty obvious to spot, because all of a sudden, every day, more listings, more buyers, more transactions.
Oh wow, the flywheel had already started kicking
the
in.
flywheel just starts, and and just doesn't stop. And even when you stop marketing, things keep going. And so it's reasonably obvious. Like if we were listing an item, the probability that it would sell, like at first was 25%, which was already liquidity, but like grew to like 50, 60%. So all the items listed would sell, consumers would be happy, and just it just kept going. So the unit economics were, by the way, underwater for a long time. So our revenue per user is like $1 or $2 a year at that point in time, because we're only on an advertising model in countries with low GDP per capita. And acquiring customers would cost us more than that. Nonetheless, the idea that you pay for the first customers and then they lead to more. And so the flywheel, it was pretty obvious that the flywheel was working in these 4 countries. So we went from 100 countries down to 4, really doubled down on the ones that we thought had like real strategic value. Obviously, if we're going to win Portugal and Pakistan, I might as well win it. But that's not we're going to create a multi-billion-dollar company. It's going to be Brazil and India. So we really doubled down there, grew it, became very large, even profitable in Brazil. And then once we were there, used those profits to then rescale to 30 other countries and become the leaders in 30 countries overall.
Did you start off by only wanting to angel invest into marketplaces, or did you have a bit of a spray and pray approach, but then ultimately found your footing with just marketplaces?
So before I move on to answering this question, I'll give you a sense of scale. So OLX became huge, right? It's like 300 million users a month. It's like tens of millions of people making a living off the site every month. We grew it to, I think, 11,000 employees at the peak. I mean, huge company. Now, my mission was always be founder CEO. I never meant to be an angel investor. I never meant to be a VC. But what happened is when you're a very visible internet founder, a lot of other founders come to you for advice and or money. And so back in 98, at the very beginning of my journey, already other founders were saying, hey, can you invest in my startup? And so I thought long and hard, like, should I be an angel investor in parallel to being a founder? I mean, it is a distraction in a way. Having thought long and hard, I ultimately articulated, I guess, 3 things. One is, if I can articulate lessons learned to others, it means I've internalized them, makes me a better founder. Number 2, I'm running these horizontal multi-category sites like eBay or Craigslist type sites, actually meeting and keeping my fingers on the pulse of the market by meeting all the verticals and understanding the latest trends and business models also makes me a better founder, and it's actually useful to make sure I don't miss any of the bigger trends. And number three, to minimize distractions as long as in a 1 hour meeting, I decide if I'm going to invest or not, and therefore I'm going to stick to things I know, like marketplaces. It's okay. And so I created my 4 selection criteria and started investing already into 98. And so by 2013, when I sold and left OLX, I'd already made 173 investments, at like dozens of exits, even though it was a secondary business for me. In fact, it was funny. In the US, I was known more as a super angel than I was known as a tech founder because OLX is not big in the US. So even though OLX is like literally one of the largest websites in the world, I was known as an angel, even though that was like my night gig, not my main gig.
So you saw it as an opportunity to actually help OLX, help yourself in that journey with marketplaces. You ended up formalizing that angel investing process by forming FJ Labs, which has gone on to make 1,100 investments, 300 plus exits. It's remarkable. It's a VC fund, but a super angel type model. Could you tell us today what FJ Labs looks like, what you're looking for, what kind of investment sizes you do?
Yeah, so first of all, we didn't start out as a VC fund. We started really as my partner, Jose, and I were like, hey, we like building companies, we like investing in companies. It'll be a family office to do that. And it kind of took a life of its own, and we started getting, beyond getting it inbounded by massive volumes of deals. Like every week we get 300 inbound deals, which required a structure. So we had to hire people, etc. We started getting inbounded by investors who said, hey, we want exposure to what you're doing. Can you let us invest? And that's what led to our first formal venture fund in 2016 of like 50 million of external capital. It led to our second venture fund in 2018 with 175 million of capital from 20 LPs. Third one in 21 with 290 million for 50 LPs. And we're about to go to market. We're going to raise fund 4 of 300 million in Q1 25, and we do a fund every 3 years. So like fund 5 will be in Q1 28, and so on and so forth. And so it kind of took a life of its own. But to your point, we don't behave like VCs. We behave like angels. You know, like 2 1-hour meetings over the course of a week, and we decide if we invest or not. Now, what are we looking for? I'll answer in multiple ways. You know, we, as I said, we behave like angel investors. So we invest in every category, in every geography, at every stage. But we're 50% US. 25% Western Europe, 10% Brazil, India, 15% the rest of the world. We're 70% seed and A, so we're mostly post-launch, post-revenue. We want to fund your growth, but we are also 20% beyond words and 10% pre-seed. We are 70% marketplaces and network effect businesses, mostly in B2B marketplaces these days because you need to digitize the entire supply chains in the B2B world, which are at the very beginning of their digitization processes. And that's everything, like moving the online ordering of like inputs to online, or moving input ordering online, helping SMBs digitize, doing support infrastructure for all this, so like payment networks, shipping, etc. But I guess most importantly, what we look for is we have 4 selection criteria. So when we decide to invest in a startup, it's 4 things. 1, do we like the team? Now, every VC in the world will tell you, I only invest in extraordinary founders. But it can't be like porn. It can't be something like, oh, I only recognize it when I see it. And so for us, an extraordinary founder is someone who's amazingly eloquent, visionary salesperson, and, so Venn diagram, intersection of those two, knows how to execute. And the way in a 1-hour meeting we evaluate if someone knows how to execute is number 2 selection criteria. Do we like the business? And for us, it's like total addressable market size and more importantly, unit economics. Can you recoup your fully loaded customer acquisition costs on a net contribution margin basis in 6 months? Can you 3x it in 18 months? Do you have negative revenue churn such that ultimately your LTV to CAC is like 10 to 1 or 20 to 1? And if you're not there, why are you going to get there with scale without needing every star in the multiverse to align? There are some VCs who will say team is everything, the rest is relevant, no, but we care deeply about the business you're in. Does it have a good economics? Number 3, what are the deal terms? Now, nothing's cheap in tech, but is it fair? Is it fair in light of the traction, the opportunity, the category, and the team? And number 4, what is the thesis? Is the thesis aligned with our vision of the future of the world? And we have clear visions for the future of mobility, of food, of real estate, etc. And we're trying to solve 3 fundamental problems: so climate change, inequality of opportunity, and the mental and physical well-being crisis. Are you solving something we care about? And we want all 4 things to be true simultaneously. So we need to love the team, love the business, find the deal terms fair, and like the thesis and the problem they're trying to solve. And if all four are true, after 2 1-hour meetings in a week, we'll tell you we're in. We'll write 100K check on average, and we'll be super helpful to you in terms of fundraising and think through marketplace dynamics. But we won't bother you. We won't be on your board. We'll take whatever reporting you're willing to give us. And yeah, we want to talk to you really once a year when you go fundraise. And we're going to make sure you nail your fundraising.
That's quite a high benchmark. I imagine you have to see quite a few deals to build the portfolio size that you're after here. Could you give us an insight on how much you actually see and what that actually results in over a 12-month investment period?
So we see about 300 deals a week inbound. They come from 3 sources. We share a lot of deal flow with other VCs. So we're friends with about 100 VCs. We talk to them once a quarter, so it's about a VC a day per quarter. And we send them all of our best deals, and they send us in return their best deals. Now, of course, we're more prolific than they are, so we send them more deals than they send us, but it's kind of win-win-win. When they send us a deal, we give them a perspective. We're going to help the founders with their marketplace dynamics. In return, we send them a lot more deals, and our founders get funded by the best VCs, so they love it. And we're not competing for allocation. They're writing a $10 million check. We're writing a $400K check, so it's not a big deal. So these deals are probably the best quality. That's about 100 deals a week. Another 100 deals a week are coming from the founders we backed before. 1,100 companies, about 2,000 founders. They come back with the next company. They send us their friends. They send us their employees. So of the deals we invest in, about 50% come from the VCs, about 30% come in from the founders. Now the last third, the last 100 a week, come cold inbound. Mostly to my LinkedIn, some direct to my email, but frankly, Instagram, WhatsApp, I mean, you name it, it's like kind of all over. 20% of the deals we do come from the cold inbound channel. And while they're lower quality on average, some of the more interesting deals come from that channel because it's like amazing founders. They just happen to not come from Stanford and live in SF. They're in like Albany, New York, or they're not in Sao Paulo, they're in Belo Horizonte, and they didn't go to the right schools. They don't have connectivity. Of course, it's better to get a warm inbound, but if we don't have it, that's fine too. And so we see 300 deals. We take calls about 50. The other 250 are often completely out of scope, biotech, hardware, etc. If there's not a marketplace, network effect type dynamic, we'll do any industry, but it has to have that, right? Like, so if you're telling me you're building a marketplace for something in space, that's fine. But if you're building like rockets, we're less likely to invest. So a lot of out of scope. A lot is also just too early. And look, we do pre-seed and pre-launch, but because we don't invest in competitors, if 8 people are pitching us the same idea at the same time, we want to wait until one of them is emerge as the early leader before we pull the trigger, because if we're wrong on the bet or in pre-seed, then we've shut ourselves out of the category completely. So we're more likely to wait until seed or A than do pre-seed, unless you're a second-time founder or third-time founder, and we've backed you before. Then we'll do pre-seed, but our pre-seed bar is very, very high. And so we take these 50 calls a week with a 10% investment team. It's a 1-hour call. We evaluate the 4 things I discussed. We have a 2-hour investment committee meeting on Tuesday, every Tuesday from 10 to 12. We review the 50 deals. We take a second call with maybe 10 other companies. One of the 4 partners will take many of the calls, but I'll take maybe half of them. And at the end of that, we invest in about 3 new companies per week. So 300 becomes 3. So it's 1%. It's 150 new investments per year, not including the follow-ons and the companies we already invested in. And of course, so we have a separate investment committee every week for whatever companies in the portfolio are raising, going public, going bankrupt, whatever. And we decide what to do. And we treat those as net new investments. Knowing what we know now of the team, of the company, of the opportunity, would we invest? And if the answer is yes, we write a check. And the answer is no, we do nothing. Or if a secondary is available, we might take a secondary opportunity on the way up. And so that's another maybe 75, 100 investments a year. So total, we end up doing 200 to 300 investments a year, of which 150 are net new on average.
Flipping back to founders and advice to founders, given your experience with marketplaces, are there like 3 top pieces of advice that you'd give a founder who wants to build the next marketplace for something?
First thing is it's easier to build than ever before. So don't overthink it, just launch, build it. I'd probably build on Shopify, even though Shopify is more for e-commerce than marketplace, and you can then build the seller component on top of it. Don't overthink the tech. Just keep it simple. Literally, I could probably build any marketplace today if I'm selling for less than 15K in like a month. Use Shopify. We have companies doing hundreds of millions of GMV and revenues on Shopify. It's not a problem. It's not where the key success factor is. The key success is, can you make the unit economics work? Can you acquire the sellers and the buyers? Can you match them? Second big recommendation, probably the number one mistake marketplace founders make, is they overwhelm their marketplace with supply. So when you start a marketplace, 99% of the case, you're going to start with the sellers because they're financially motivated to be on the platform. If you kind of go to anyone in any category, it doesn't matter what they're selling. They could be selling a service, they could be selling a product, and you're like, hey, I'm creating this store. It's free for you to be on it. I may have buyers for you. Do you want to be there? Everyone's going to say yes. Like there's a very limited cost for them to be on it. But if you just take everyone and you have infinite supply and you don't have any buyers, then none of these are going to get any value out of your marketplace, and they're not going to have buyers. As a result, they're not going to be active. They're going to churn, right? If I wanted to build a locksmith marketplace in New York City, I don't have any locksmith there in New York. A couple thousand, I could probably call every one of them in a month and get them on a platform. But I'm going to have no demand for them, so they're all going to churn. If someone places an order, they're not going to reply. They're not going to be engaged in the platform. So instead, what you should do is you get the very best supply, a good price, good operator. Depends if it's a product or a service, but like the very best seller for that product category, and then like a limited quantity, and then you go find them a buyer. Spend money, and it doesn't. I also don't care at the channel. It could be influencers, it could be TikTok, it could be Facebook, it could be Google, it could be sales team, it could be inbound. Irrelevant. Just make sure that the economics work. So you find them a buyer, and you make them happy, and then they scale the amount of time and products that they put in your platform relative to others. And once you've reached kind of saturated them, then you bring the next seller. And you keep scaling your supply and your demand in parallel. You don't massively scale one side before the other unless there's value in having more items, which are some categories you need a critical mass of items before you can actually attract buyers. Otherwise, you're going to overwhelm your supply side. Nothing's going to convert. The sellers are not going to be engaged, and everyone's going to churn. And you've drowned your marketplace and you've killed all chance of liquidity. So really scale up the supply and the demand in parallel, making sure both sides are happy at all times.
That's fantastic advice for the MVP, the founder that's just about to start their marketplace. When it comes to a founder that actually has taken that step, do you have any advice on what to do then?
So obviously finding product market fit is the number one thing that kills or at least success in startups. All I would say is, look, if you're 20% away, you're gonna figure it out. Like you're gonna change the funnels in a way that you're gonna get there. You're gonna get optimizations in your marketing channels, etc. If you're 10x away, you're probably not going to get there with whatever it is you're doing today. You need to change something pretty radical. Product, user experience, business model, distribution strategy, etc. So if you're far away from it, probably not going to get there, which is okay. You use that lesson and pivot into something else. And if you're close, just keep iterating on whatever current approach you're doing. Now, there's some things you need to realize is some things solve themselves automatically through scale. So imagine your economics are underwater because you're paying the delivery people, or they're being paid in the marketplace $15 an hour, and you're doing one delivery an hour. But at scale, you can easily imagine that it'll be 3 deliveries an hour, and so $5 a delivery, not 15, and there the economics work. Then you can still articulate why you're going to get there. Now, understand this: VCs like me, we want to fund growth. Now, we're not going to fund profitable growth, but not profitable as in you reach underlying profitability, profitable unit economic growth. So the objective of your seed is to go to your A, the objective of your A is to go to your B, and from B, then you can go to full-blown profitability. But let's say you're a consumer-facing marketplace with like a 15% take rate. At seed, you're probably raising the median right now 3 and 9 pre, and we expect you to be doing 150K a month in GMV. And with that, again, 15% take rate. So if you're at 5% take rate, you need to be 4x bigger or whatever, or 3x bigger. With that, we expect you to be at 750K in GMV with a 15% take rate and good unit economics, like 66% margin, let's say, for your A. And with that, you get whatever, 2.53 million a month in GMV for your B, again, with good economics. And we expect the cohorts to improve over time. So the more you go on, the more valuable, if you're a marketplace, typically the more valuable the community is. The more items you have, the easier it is to transact. And so we would expect new users to come in to buy faster, to buy more, and to have a retention that is higher. And so if pretty quickly you see that the new cohorts are worse than the old cohorts, it may mean the market is smaller than you think it is, because it suggests that you already got all the early adopters and then the rest are not that excited or interested in the category. So yeah, cohort analysis matters a lot. LTV to CAC models matter a lot, and also making sure you have density in your acquisition channels, because if you're doing Google, which is totally fine, make sure that you can spend not just 100K a month, but like a million a month or 5 million a month, and then you keep scaling. You have proper network effects when your CAC goes down over time. If you have real network effects, you start getting more and more organic growth. So your blended CAC should actually be declining over time as you scale. If your CAC keeps going up and up and up, again, it probably means either you don't have network effects or the market is more capped than you thought it was.
With this AI boom and tools that are so easy for people to code now, is there anything particularly exciting about applying AI to marketplaces that you're seeing happen today that hasn't happened before?
Well, first of all, every founder should be using AI to improve productivity in their startups, right? Like customer care productivity can improve dramatically with AI, sales productivity can improve dramatically with AI, programmer productivity improves dramatically with AI. So you should be using the AI tools. I mean, I take that as a given. Now, you could also use AI to improve marketplace flows pretty dramatically. In some categories, now you can just take a photo and the AI can detect the item, pick a title, write a description, select the category, select the price, say if it's real or fake, and like poof, in like three photos, 20 seconds, you have a listing. Compare that to the old school way of doing it on eBay, where you do all that work for yourself. It's like 10 minutes to put a listing, plus you put a credit card details, etc. So you should definitely use AI to improve buyer and seller flows to the point that you increase conversion rates, basically. In some categories, it's very easy to do, like trading cards or collectibles, where the items are like can be recognized or unique. In some categories, it's less easy to do and may not be, and the incumbents are probably in a better position to do it than the startups because they have the data. So Rebag, which is a handbag marketplace, has all the data of all the handbags, which one are fake or real, and what price based on the level of scratches and etc. And so they've created their AI called Claire to help you list your handbag. They can do it, but if you were just a startup starting, probably you don't have the data to be able to do that. But there's also third-party AI tools that can help on the marketplace. So we're investors in a company called PhotoRoom, and what PhotoRoom does is you take photo of an item, it detects the type of item it is, and based on the marketplace you want to sell it on, it'll change the background image of your photo to maximize the conversion sell-through rate. So sometimes we'll put a white background, sometimes we'll put it in nature or whatever. I mean, so there's a lot that can be done from an AI perspective. And of course, depending on the search behavior, you can improve your search and your recommended listings, like what you like this, you may also like this, through AI in a pretty dramatic way. So these are the most fundamental ways to use AI in marketplaces.
Incredible. I really like the idea of investing maybe into a startup that needs marketplaces as a customer. So that photo room, obviously you can
Yeah,
give them instant scale. You've got 1,100 portfolio companies, many of which are marketplaces. Bam,
exactly.
instant go to
We're
market
investors with
strategy.
TopSort. TopSort helps marketplaces monetize by selling ads to their own sellers, kind of like Instacart or on Amazon right now. You can buy ads as an Amazon seller, and so it increases your take rate, and it's very profitable, very profitable. And so we invest in that, and of course then we send it to all portfolio companies, and it's win-win. TopSort gets all of our marketplaces as customers, and the customers get higher GMV take rate. So it's amazing.
Incredible. And just end by saying thank you very much for your time. The wisdom is incredible. For the founders out there that want to approach you, want to get investment from FJ Labs, where would you prefer that they send you deal flow?
So if you want to learn more about my thinking, read my blog, fabricegrinda.com. You can actually talk to my AI, Fabrice AI, at fabricegrinda.com. So fabriceai.fabricegrinda.com to ask any questions you may have, not to approach me directly to send me deals. The best way is to send me a LinkedIn in-mail. And in that message, though, make sure you describe what the startup is, what traction you have, include a deck. Basically, give me every information I need to decide whether it's for us or not. If you just say, hey, I have an amazing startup, I'd like to talk to you about it, you will not get a reply.
Perfect. Okay, thank you very much. I'd love to start sending you some great deal flow from OpenVC. We need to get involved in that quarterly sharing agreements that you have with other VC funds. But for now, thank you very much. You've been an amazing guest, and this is a fantastic episode.
Thank you for having me.